Let's look at country and political risk. We're going to look at what that type of risk involves, how you might control for it, and how it's often measured by major institutions. Now, country risk is basically a concept that involves risks associated with that country, but it has various different types. So political risk would be one of those major risks that's associated with, for example, political machinations. It could be the risk of something like a coup, but it could be the risk of a major institutional turnover that's at that country level. It could also be some risk related to that country expropriating wealth. This would be something that's due to the government organization, and it could also involve factors such as the government arresting individuals without clear and defined charges. That would be a violation of something called habeas corpus, which is a dominant theme in, say, Australia, for example, which helps to limit political risk in that environment. You can also get financial and economic risk. Now, financial and economic risks are things that are not merely due to political factors. So those political risks are due to political issues, due to the issue that a government might intervene and destroy wealth. The financial and economic risk factors are more due to financial and economic policies that might arise. So, for example, they might relate to merely excess government debt, which can, of course, have a political dimension, but here we're more referring to the financial aspect of it. So there could be excess debt, it could be that there might be some particularly problematic trade surplus or trade deficit, which might have on-flow effects. It could be that the government is attempting to control the currency in a way that appears to be risky. In any case, there are several ways that you can measure political risk and also measure financial risk. So if we're looking at financial and economic risk factors, there are various red flags that might arise. They might relate to the amount of debt the company has, or country has rather, in relation to its GDP, or in relation to the exports it's generating, or in relation to, say, other measures of economic activity. We might also look at the ratio of the country's imports to its exports, so whether there's a current account deficit, and whether that's a problematically high deficit that has been persisting for a long time period. We can look at the terms of trade, or we can look at various other economic factors that might exist, and whether, for example, that country might have baked in what's called a structural deficit, which is a deficit that's due to high government expenditure that can't merely be reversed. It generally relates to things due to, say, social security measures, which are perhaps too high for how much money the country is taking in. So those types of factors could connote financial and economic risks. Those, as I've indicated, are separate from political risks. The political risks, just to reiterate, are factors that are due to the political environment in which you're going to be operating, and are due to political machinations. So what exactly are political risks? Well, I'll look at some major types of political risk here. Now, one major type is expropriation or nationalization. That refers to the concept where the government takes over property and/or businesses. In the extreme case, the government simply seizes all of that property. In a less extreme case, they might seize some property and pay token compensation. Now, in many developed countries, the government does have the ability to take property, but they have to pay just terms for doing so. It's highly controversial when the government does this, but nevertheless they have to pay compensation. For example, in Australia and in the United States. In some developing countries, and some with very weak regulations, the government might simply step in and nationalize organizations. An example of this would be Venezuela, which has seized organizations and seized private property, which is hugely problematic from a political risk perspective. We can think about a related concept here, which can be trumped up charges against private individuals running corporations. This can often lead to the government becoming involved in the corporation. It's effectively expropriation by stealth. Here, if there's weak criminal law, or at least a weak justice system, the government might develop fabricated charges or not well substantiated charges against private individuals, and then use this in order to either get back at those individuals and/or intervene in the corporate scene. That obviously is problematic as well. It would undermine the rule of law and habeas corpus, but it also creates issues from a political risk perspective for a corporation if their executives face arrests on political charges. We have the issue of contract repudiation as well. Now, contract repudiation arises where the companies or the governments simply refuse to uphold their end of the bargain. Now, ordinarily, if one breaches a contract, one has to pay damages to represent the value of the loss of bargain to the counterparty. However, if the government simply repudiates a contract and refuses to uphold its end of the bargain, That's another form of political risk. A related concept here is if the government is too lenient with issuing force majeure certificates to its own corporations with respect of overseas counterparties. That creates a major political risk when dealing with corporations in that country, because those corporations might simply avoid their contractual obligations by falling back on a slightly dubious certification of force majeure. That's hugely problematic as well from a political risk perspective. It has a negative impact on the value of the operations that are ongoing there. We also have taxes and regulations, and in particular, issues in relation to unwanted and perhaps random and perhaps substantial changes in taxation. In particular, what we're looking at here is major structural breaks to taxation regimes. One example would be during the most recent federal election in Australia, where the Labor Party proposed bringing in significant changes to property taxation, which would have significantly increased property taxation. That would have created a major structural break in the property market and could easily have caused property price declines in the vicinity of 10+% according to analysis at the time. That would form a degree of political risk, because the risk of the ALP in that case bringing in such regulations creates major problems when you want certainty in relation to the investment environment you'd be going through. So those types of changes, particularly adverse changes, create a degree of political risk here. You also have exchange controls, which can create almost implicitly political risk. Now, these would be situations where the government prevents you from repatriating your money at a certain time period. This effectively limits the ability to convert that domestic currency into the currency you want. You effectively then held up keeping your money in that foreign country, which then can potentially expose you to increased corruption, expose you to an inefficient legal system. It amplifies the amount of risk that might exist, particularly if the other forms of political risk I've talked about are dominant or at least ongoing in that country. So it's hugely problematic as well when you're looking to invest and invest with certainty. Now, in terms of country risk versus political risk, country risk is more or less the idea that might capture all levels of country-related risk. Now, these country risks aren't necessarily always due to political risk. So country risk can involve things such as ethnic violence that might be ongoing that isn't per se due to the political system in charge. That is, the political system might not necessarily propagate it. There can be civil wars ongoing in countries, or at least turf battles ongoing in countries, that the government isn't actively trying to stoke. Now, oftentimes the government is involved in that, so oftentimes there will be overlaps between political risk and country risk, but nevertheless there can be other underlying country risk factors that might exist. They could involve many factors that can create unrest and can jeopardize the financial viability of particular projects. We can also get home country restrictions, such as if you're a foreign investor investing in an overseas location, your home country might create a degree of risk there as well. So for example, if you're a US country that's looking to invest overseas, or a US company rather, looking to invest overseas, at one point the US brought in a trade embargo with respect of Cuba, for example. That creates a degree of risk there, particularly in relation to the country that you're operating in. So that risk is due to more the political changes in the United States, changing your ability to operate in Cuba more than the actual political environment in Cuba changing per se. Nevertheless, that type of country risk can clearly arise and clearly create problems when you're going about trying to invest. So that US embargo with Cuba was a problem. US trade embargoes with Iran that are periodically ongoing also create issues in relation to investing overseas. And sometimes those can create problems when you're looking to try to make overseas investments. Now, in terms of incorporating political risk into capital budgeting, one would need to either change the cash flows or change the cost of capital for the underlying project. By changing the cash flows, you're effectively looking at the expected value of that risk. By changing the cost of capital, you're effectively discounting cash flows to represent the higher degree of risk. So you would adjust either of these two. So you could adjust the cash flows. Effectively, what you would be doing here is you would be reducing the expected value of the cash flows if there's a risk that those cash flows might not necessarily arise. Now, this can arise whether or not it's an infinite stream of cash flows, or if it's got a project that's only going to last for a certain time period. Here you would use the ordinary discount rate, i.e. you wouldn't adjust the discount rate for that political risk, because if you were to do so, you would be double counting. Now you would also need to compute a probability distribution of each of the events occurring. So a good event where no political event occurs, or negative events where degrees of political risk might eventuate. And then you would compute the NPV of that project as normal. You would do that by getting an expected value of the project using your probability distribution. Here the expected value would be the summation of the probability weighted cash flows that might arise in each eventuality. So you'd be multiplying the probability of that cash flow by the cash flow that you would receive in each state of the world. You could also adjust the discount rate that is applicable. Now importantly here, you would not do both because you would be double counting if you were to do so. Now adjusting the discount rate would reflect the riskiness of the project and the underlying cost of capital for that project. Here your discount rate would change to reflect that risk. Which one you do is going to depend on which one is the most straightforward, but also the most intuitive, but not only that, the most clear in each state of the world and each scenario. Now in this case, you would adjust the cost of capital hypothetically by using the probability of an event occurring. Now I've mentioned down here that the adjusted cost of capital could be the ordinary cost of capital plus the probability of the negative event occurring divided through by 1 minus the probability of that event. And we'll see why that's the case in a little bit. So let's look at an example to see how we might incorporate this risk into cash flow analysis. And in particular here, we're going to focus on looking at the probability of each event and the cash flows that might arise in those events. So in this example, your friend operates a Kobe Bryant fan shop. He had set this shop up under Kim Jong-il in North Korea. Now, because Kim Jong-il was a fan of Michael Jordan, he didn't really fear expropriation. However, that of course changed over time. Kim Jong-il died and Kim Jong-un took over. Kim Jong-un is a Kobe Bryant fan, and therefore you start to fear expropriation potentially occurring. There's a risk that the North Korean government might take over your shop, and this is something that might concern you. So therefore you might want to look at, well, what is the probability of this occurring, and in particular, what are the cash flows if it does occur? So as an illustration, here's Kim Jong-un inspecting very expertly a mattress, and of course, Kobe Bryant, the subject of this fan shop. So if we look at this example, we can see several things. So your friend believes there's a 70% chance of expropriation. Now, that's obviously a high situation or a high risk. But of course, in North Korea, that's probably quite realistic. And in fact, it could be higher than that if you're operating a shop. Now, there's a belief that this could occur in the following of the 2 years. Now, after 2 years, your friend decides that he's just going to shut the shop anyway and then move into another line of work. Probably try to move out of North Korea if that's appropriate and possible for him. So he plans to operate for 2 more years and then sell if possible. However, of course, in each of those years, there's a risk of expropriation, both in year 1 and in year 2, with 70% probability of expropriation in each time. And if you're expropriated, you obviously get no cash flow. So if we look at our decision tree here, we start off at time 0. Now there's a 30% chance we're going to get a cash flow and a 70% chance in year 1 we're going to be expropriated. Now say hypothetically you get $10 cash if you succeed in that first year, just so that we can put some numbers on this. Now obviously the amount of you selling this is going to be more than $10, but still just so we have some numbers here for illustration. Now say we go through to year 2, because your friend will want to sell after year 2. Now there's again a 70% chance of expropriation, and then you get no cash flows in year 2 if expropriated. There's a 30% chance that you're not expropriated. Now hypothetically you can then sell off everything for $25 if you're not expropriated. That would involve the remaining stock, maybe anything else you were able to sell and salvage, and then you would end up leaving. So let's have a look at this and what this means for the valuation of the project. Because obviously, if you're not expropriated, then the value of the project will be much higher than if you are. That goes without saying. What we need to do is calculate the expected value of this project. Now suppose we apply a discount rate of 16%. So for example, that's a relatively high discount rate, but for a store that's relatively small with quite uncertain cash flows in any ordinary time, 16% could hypothetically be appropriate. Let's just assume that it's 16% and see what you can sell this store for today. I.e., we're being asked, what is the value of this store if we could just offload it right now? So what then is the value that we get? Well, we can look at this effectively by looking at a scenario analysis here. So under our scenario analysis, we've got three scenarios. We have, for example, no expropriation occurring ever. Now that occurs with 9% probability. How do we get that 9% probability? Well, it's 30% chance of no expropriation in year 1 multiplied by 30% chance of no expropriation in year 2, i.e. it's going to be 0.3 multiplied by 0.3, which is going to give us 9%. Now what about the present value of that? Well, here we've got two cash flows, $10 in year 1 and $25 in year 2. So we get the present value of those by discounting them back at 16% for the requisite number of years. So 1 year or 2 years as is appropriate. So this gives us a present value of about $27 if there's no expropriation. Now say there's expropriation in year 1. In that case, we get no cash flow whatsoever. That occurs with 70% probability, which is just the risk of expropriation occurring in year 1. Now again, there's no cash flow occurring at all there. Now if there's expropriation in year 2, we then get a cash flow in year 1. So our present value of the cash flow is going to be $10 divided by 1.16, i.e. $10 discounted back 1 year. Notably here, we get no cash flow in year 2. So therefore the present value in that scenario is $8.62. Now this occurs with the probability of effectively here lasting the first year, then being expropriated in the second year. So here there would be 0.3 multiplied by 0.7. Effectively a 30% probability of lasting the first year multiplied by the 70% probability of being expropriated in the second year. Now we can sum all of this up, and when we sum all of it up, we effectively end up with a net present value here of $4.26 when we're looking at this using an expected value type framework. So it's super simple to do, assuming you can work out the probability of expropriation or the probability of the adverse event as is relevant to the thing you're trying to analyze. Again, it's a relatively straightforward process here. Now, our present value is clear in this case. Now, if we have an infinite series of cash flows, the situation becomes slightly more challenging. It becomes slightly more challenging because we need to work out, well, what happens if we have expropriation risk in every single year? And we've got a few different scenarios here. We have, firstly, you've got a risk of being expropriated in year 1, and then the rest of it's okay. Basically, you just need to last 1 year. Basically, that's the least risky here. The next one, or a second scenario, is there's a constant risk of expropriation every single year. Another scenario is there's a decreasing risk of expropriation. That's probably more realistic because as you become more and more entrenched in society in that company, or in that country rather, the government loses more if they expropriate you. The reason they lose more is as you become a more established player in that market, you become a more local organization with more workers being more loyal to you, and you're providing jobs and income to the country. So the government gains less from expropriating you in that case. They'd probably just be better off keeping you as a private organization and taxing you than expropriating you. So we need to consider those types of scenarios that might arise. And they all lead to slightly different answers in terms of the net present value of these investments. So for example, we have an oil investment that generates 50 million per year, or is at least expected to do so, assuming it continues to operate. So if we've got that as a situation here, we just have an infinite series of $50 million going forever. We can value this as a perpetuity. To be clear, the value of a perpetuity is the cash flow divided by the cost of capital. So in this case, it's 50 divided by R, whatever our cost of capital we deem to be. So suppose we deem the cost of capital to be 10% here, then the value will be 50 divided by 0.1, which is going to equal to 500, which is relatively straightforward. But so far we haven't incorporated any risk of expropriation. Now suppose we've got expropriation risk, and there's political risk which reduces the value of the project. And the probability of that risk occurring is with probability P. And for example, say it's constant over time. So we've got a constant risk of expropriation, for example. So in that case, what we'd end up with is a valuation that would look as follows. For example, our first year, we've got a cash flow of $50. It occurs with probability P, 1 minus P. So if P is our probability of the political risk, then 1 minus p is the probability of actually getting the cash flow. And then we discount it back 1 year as before. Then in the second year, it's 50 multiplied by 1 minus p squared, then cubed, then so on and so on. Now it turns out there's a neat formula to do this. So let's just slightly rearrange this, and we can take out a common factor here. A common factor in each of these situations is 50 multiplied by 1 minus p over 1 plus r. That's a common factor here. So let's take out our common factor. Then we're left with an infinite series of 1 plus lambda squared, etc., forever, where lambda here is 1 minus p over 1 plus r. So lambda here is just a pronumeral representing this expression. This enables us to actually solve for this summation, because there's a neat formula to solve for a summation of an infinite decreasing series. Now, we're not going to get a closed form number for an increasing series, but for a decreasing series, we can. And you'll notice here that each of these lambdas, so lambda squared is smaller than lambda cubed is smaller than lambda squared. This enables us to do a summation. So the summation formula is the sum is going to equal 1 over 1 minus lambda, where lambda, as before, is 1 minus p over 1 plus r. So we're able to do a summation here, and therefore get a valuation. So if the probability of expropriation is equal to 12%, then we can see what we obtain. We're going to obtain a valuation here in this formula. So we have 50 multiplied by 1 minus p over 1 plus r. Then we're multiplying it by our 1 over 1 minus lambda. So here that would be 1 over 1 minus p over 1 plus r, where p is 12% and r is 10%. And this is going to give us a formula over here of 50 multiplied by 1 minus 12 over 10% plus 12%. So we end up with a relatively easy formula here that is going to be relatively easy and straightforward to compute. Of course, it does rely on knowing the summation formula, but is relatively straightforward when we've got this constant risk of expropriation using the types of mathematics that we know and can apply. We can look at another scenario, which is where the probability of expropriation only occurs in the first year. Basically, we just need to last first year, in which case we have two scenarios. The first scenario is effectively we last the first year, and that occurs with, say, 88% probability under our numbers. The second scenario is we fail in the first year, which occurs with 12% probability under our numbers. Now, if we're expropriated in the first year, we have zero cash flows whatsoever. If we last the first year, then we get an infinite stream of $50 each year. So therefore, our valuation is just going to be 88% multiplied by the value of an infinite stream of cash flows. So 88% multiplied by 500, which is going to give us 440 million. It's basically very much the same as when we're valuing the perpetuity of cash flows, but here we just multiply it by the probability of actually getting those cash flows, which on our numbers is 88%. Now, another scenario is where after the first year, the probability of expropriation goes down. Now, we can do this in multiple ways. We can scale it down, so 12% to 11% to 10% to 9%, etc. Or we can just take it down in one step, which is going to be a more straightforward illustration and is simple enough for our purposes. So, for example, the probability of expropriation in the first year is 12%, but then the probability in the next year is 1%, which of course is more realistic because the firm might have become more entrenched in that country, and therefore the government realizes the company is generating value and just decides to keep employment going and keep taxation revenue coming in, which is a pragmatic approach by the government, assuming the company doesn't do anything that's particularly problematic for the government. Okay, so we can see how this could be valued, and effectively we're going to end up with two different categories of cash flows. The first category is where we have this high level of expropriation. The second category is where we have that stable level of expropriation that lasts forever. So in this case, for example, we have a 12% probability in year one, then in every year thereafter, there's a 1% probability of expropriation. Here we can value it in two cash flows effectively, and two approaches. We've got that high probability in the first year, and then for all years thereafter, we just value it using that infinite series formula that we saw before. But instead of using 12%, we use 1%. So let's have a look at how that might work when we put some numbers to it. So here, for example, our first cash flow occurs with 88% probability. So 88% multiplied by 50 over 1.1 rather, which was our cost of capital here. Now, say we look at our second cash flow. Our second cash flow occurs with the probability of lasting the first year and lasting the second year. So 88% multiplied by 99%. The third cash flow occurs with probability of lasting all of the years. So 88% by 99% by 99% again. So we effectively have multiplied it 3 times. So you'll notice this 99% starts to compound over time. But all of the cash flows are multiplied by 88%. So 88% is a common denominator here. So we can start to use this. So what we first have is our first cash flow. Our first cash flow is $44 divided by 1.1. That's the one where we have a probability of expropriation of 88%. Then for any year thereafter, we can take out a common denominator. Our common denominator is, in this case, 43.56 over 1.1 squared, or a common factor, sorry. Now, effectively what that means is we've been able to remove that from each of the individual equations. That's effectively going to account for 50 multiplied by 88% multiplied by 99%, then we're dividing through by 1.1 squared. The difference from the first time we did this is we now have an infinite series occurring 1 year into the future compared to what it was before. Hence our extra year of compounding here. And then we end up with our infinite series, and we can apply our formula as we did before. So when we do this, we end up with a formula of $400 million, or a value rather of $400 million. So you can see here it's better than when we have this risk of expropriation being 12% in every single year, but it's obviously not as good as if the risk of expropriation goes away after the first year. So we still have our risks arising here, but we have multiple ways of actually going about valuing it as is appropriate to the thing that we're trying to deal with. Now, we could alternatively have adjusted the cost of capital in the way that I'd mentioned earlier on, where we could adjust our cost of capital to 12.5% using the formula that I'd previously alluded to. Now, we can measure country and political risk in several ways by using various established agencies and organizations to do so. So, for example, there's this International Country Risk Guide. Now, I won't go into that in too much detail, but they effectively try to assess countries' political risk, and economic risk and financial risk. They do this using a combination of objective measures, so things like GDP-related measures, so debt to GDP, etc. But they also use subjective measures, which are going to be matters that try to assess the risk of corruption, for example, or the stability of the government, or relative freedoms in that country. So both of these are going to be used by the ICRG in this risk guide. And there's going to be an overall rating that might exist for these countries or for these companies. So we can see some examples of the types of things the ICRG might incorporate into a risk analysis, which include political factors, financial factors, economic factors. Now, the political factors are going to include a lot of subjective things. These, of course, could represent a degree of bias from the people assessing it, but they do try to capture the ease of doing business, as reported by corporations and other individuals about doing business in that country. You have various financial and economic risk factors, many of which can overlap in concept a little bit, but they do try to capture how solvent that government is, its ability to service debt, and therefore whether that can create some onflowing risks to corporations, i.e. in the form of expropriation, or in the form of changes to currencies, or in the form of increased taxation, that could create problems for the government or for the corporations doing business in that location. These country-level risks can give rise to country credit spreads and country credit ratings. These are effectively capturing basically the creditworthiness of this country, and whether that country is likely to repay its debts as and when they fall due. The worse the credit rating, the less reliable is that country. Now, it's often assessed by credit rating agencies, which are going to rate countries in much the same way as they rate organizations. The worse is the credit rating, the worse is the likelihood of that country repaying debt. And those credit ratings are worsened in similar ways to companies' credit ratings. Basically, the more debt you have, the worse your credit rating, especially if that debt is denominated in foreign currency. But it is, of course, going to be influenced by political risk factors as well. Now, this is clearly relevant to companies, but it's also different from company credit risk. It's relevant to companies because if that country defaults, then there's a risk of expropriation or higher taxes. So countries should be mindful of sovereign credit risk when they're making an investment. However, sovereign credit risk is slightly different from country credit risk. it's more difficult to take countries to bankruptcy court. Obviously, creditors can still try to seek their money, but it is obviously more difficult, and bankruptcy courts don't exist in the same way at a sovereign or international level as they do when dealing with individual corporations. Nevertheless, one can seek recompense in several ways. One can try to seize the assets of that country, which obviously is easy to do if those assets move into international or perhaps your own waters, as is sometimes the case with sovereign assets, and sometimes they are seized in return for the debts that are owed. Particularly when those assets move into, say, US jurisdiction, then they're often seized. The country might not be able to borrow easily in the future if they default on their debt, or they're going to borrow at a higher credit rating or a higher cost of capital. International trade could be impacted, in particular if people don't trust that country, they're going to be less likely to enable that country to borrow or purchase on credit. And default could make economic crises worse, for the clear reason that if a country defaults, it's going to be much more difficult for that country to borrow money and then resolve its economic crisis. Now, in terms of managing political risk, there are several things that one needs to keep in mind. We need to focus on the short term to begin with, because if there's a high amount of political risk, then clearly that complicates over time and it compounds over time. So as we saw in our prior example, if there's political risk in every single year, that compounds over time. So therefore it puts more weight on your shorter term cash flows. Those longer term cash flows start to get discounted effectively by that amount of default risk. So one needs to bear that in mind, and the short-term cash flows become particularly poignant in this scenario. It's useful to rely on unique supplies and technology that either are difficult to really expropriate and use properly, and in particular, hopefully those are going to be used overseas. So you won't shift your IP into that risky environment, but rather you'll use unique assets and property that rely on your overseas parent organization. So even if your local operations are expropriated, they won't be able to seize your IP, and therefore it's going to be more difficult or less beneficial to expropriate those assets. You could use local resources. Obviously, you're going to avoid shifting your IP into a country that is notorious for seizing IP. So if that country has poor intellectual property rights, and or if the government actively enables the seizure of intellectual property rights, you clearly wouldn't put your IP into that country, and you would keep it in your home market. But you would still use local resources when it comes to labor and when it comes to construction materials, because that makes the company more integrated into the local environment from the government's perspective. And then the company is providing a useful benefit in the form of employment and in terms of economic benefits, in the form of growth that might arise afterwards. And you could try to bargain with the government, as the case might be, in order to try to at least get around some of those risks that might arise, which is generally going to result in you trying to make your cash flows more short-term so you can get them out of that risky environment as early as possible. You could hire protection, as the case might be. That could be in either the actual literal sense, if you actually fear government intervention in a very conflict-ridden zone, or it could be in the metaphorical sense in the form of legal protection. Clearly, corporations are going to want to be legally mindful of what governments might do to them. And like I've indicated, the key protection is to protect intellectual property and avoid the government intervening. And if one fears the government taking political actions against you, you might need to avoid shifting too many of your high-valued resources into that government or in that country, and making sure that there is adequate protection in that respect, be it literal or metaphorical. You could also obtain insurance. That insurance could either be in the literal insurance sense or in a slightly indirect sense in the form of things like CDSs that insure against government default. Often, major political risks go hand in hand with terrible country ratings in terms of credit. So if you have a CDS, that gives you a degree of indirect insurance against expropriation. So you could, to some extent, insure your operations with something highly correlated being CDSs. Nevertheless, you might take out direct insurance, which could protect against myriad things, including expropriation. Of course, that's kind of costly. However, one can weigh up whether it's actually worthwhile. Now, one can obtain public and private insurance. Public insurance is insurance that might be obtained via a government organization. A private insurance might be obtained via a private organization. it's become increasingly important as governments and public sources have shied away from providing insurance. So we can see how insurance works using our example. So suppose your friend is able to insure the net present value of his investment, that is $4.26, and can do this by paying $2 million a year, paid up front. Unsurprisingly, it would be paid up front because if you're expropriated and go bankrupt, then the insurance company can't get their money. So it has to be paid up front. So let's see whether we'd be willing to do this. Now to do this, we need to look at what our cash flows now become. So whereas we had different cash flows for getting zero if we're expropriated, now we get the insurance payoff. So for example, it's $4.26 if we're expropriated in year 1, $4.26 if we're expropriated in year 2. But we also need to make our insurance payments. And our insurance payments were $2 in year 0 and $2 in year 1. Notably, they're paid in advance. So effectively, from a time value perspective, they're going to be slightly higher because they're paid in advance. What we need to work out is what is now the expected value of our project if we buy insurance, and is that higher than the expected value if we don't buy insurance? Now clearly here we're assuming away risk aversion and just looking at expected values, but clearly that's still worth looking at. So again, we're going to assume a cost of capital of 16%. So what then is the expected value of our project when we've got insurance? We can do this using scenario valuations again. So we've got our first scenario, no expropriation. That occurs, as you might recall, with 9% probability, which was 30% of lasting the first year plus 30% of lasting the second year. But here, our present value changes. To see what our present value is $23.48. Now that's effectively going to come from the following. We've got minus $2 in the first year. Then in our second year, we have a $10 cash flow, but we still have to pay $10 insurance. So we add on the $10 cash flow minus $2 insurance and discount it back 1 year. Then in the next year, what we have is our $25 cash flow, and we discount that back 2 years. So we end up with that present value of $23. Much the same process as before, but now we've had our insurance premiums. Now say there's expropriation in the first year. That occurred with 70% probability. Now in that case, we now do have a cash flow. In the prior situation, we had no cash flow whatsoever, but now we have $1.67 as the present value of our cash flows. So to see where this is coming from, that's effectively coming from the fact we have a $2 payment to our insurance to begin with, and then we have our payment of $4.26 in that second year. So it ends up being, in that first year rather. So $4.26 discounted back 1 year, and we get no cash flow in the second year. Now say there's expropriation in the third year. This occurs with a probability of 21%, i.e. 30% chance of lasting the first year, multiplied by a 70% chance of lasting the second year, of being expropriated in the second year rather. And that will have a present value of $8.06. So to see where this is coming from, let's think through what our cash flows would be. Our cash flows of this would end up being, we start off with a $2 premium we have to pay. Then in our first year rather, we have the $10 minus $2 as we had before, discount back 1 year. And then in our second year, what we have is we have our $4.26 discounted back by 2 years. And that's going to give us our value here, our present value of $8.06 when we've got that expropriation. We can then add it all up, and our present value when we've taken out insurance is $4.98. So that means in this case, it's actually going to be beneficial to us. It's worthwhile taking out this insurance. Now, of course, whether it is depends on the individual facts of the situation, but you can see whether it's worthwhile in an individual case, given the insurance premiums and the insurance payoffs that might arise. And here it clearly is, given that the net present value when we've taken out insurance exceeds that when we haven't. And it also is going to reduce risk. So if the individual is risk averse, this of course would be ideal. So we've seen so far how to incorporate political risk into various projects. And we've covered several key topics. We've covered what political risk is and how it can play a key role in project valuations. And we've looked at how to value it by incorporating it into cash flows and also the cost of capital, and doing this using scenario analysis. We've also looked at the value of international political risk insurance and how to incorporate that into a project and assess whether that increases the present value of a project. And we have looked at international organizations that assess political risk and how they might go about doing this. So I hope this video has been informative to you, and I hope to see you next time. Bye.